Welcome to the deep dive. Today we're digging into Anand Rathi Wealth Limited, ARWL for short. And we're asking a pretty big question. Is this company, which some analysis calls like flawless in execution, really a lifetime investment for you right now?
It's a fascinating one because you've got this really strong case for it being a best-in-class business, but then bam, the analysis also flags it as growth at an extreme price, GEE.
Right, GEP. So great company, terrifying price tag. It sounds like a classic dilemma.
Exactly. And the sources really zero in on two big risks that challenge that whole buy and hold forever idea. First, that price. I mean, the PE ratio often shoots above 70. 70 times earnings. And second, this is really key for you to understand, there's a pretty significant regulatory cloud hanging over them.
Ah, regulation. You mean the SEBI consultation paper, the one from October 2025 about mutual fund fees?
That's the one. It could fundamentally change how firms like ARWL make money. It's a
Good.
non-trivial risk, definitely.
Okay, hold that thought on the risks. Let's unpack the bull case first. If the price is so high, what's the story that gets people excited?
It really starts with the big picture, the structural growth in India. It's this huge tailwind.
The great Indian wealth boom the sources talk about.
Precisely. You're essentially betting on demographics and economic growth. The number of super rich, the UHNWIs.
Ultra high net worth individuals.
Right. That group is projected to jump like 50% just between 2023 and 2028. That's a rapidly expanding pie for wealth managers.
And ARWL has carved out a specific niche within that boom.
Yeah, they focus on the high net worth segment, or HNW. Think clients with, say, 5 to 50 crore rupees to invest. And their approach is deliberately, well, uncomplicated. It's built on a disciplined mix. 65% in equity mutual funds.
For the growth part.
Exactly. And the other 35% is in these structured products.
Yeah.
These are sort of custom fixed income things designed to give stability, regardless of what the wider market is doing.
Okay, strategy sounds clear. But let's talk about their competitive advantage, their moat. The numbers on client stickiness are frankly a bit nuts. Client attrition by AUM, assets under management, was apparently just 0.52% last year. How did they even do that?
It really boils down to their people, their human capital strategy. See, clients stick with their relationship manager, the RM. And ARWL's RM attrition, specifically regret attrition, meaning RMs they wanted to keep, has been under 1% for 2 years running.
Wow. Under 1%, that's almost unheard of in wealth management. Competitors bleed RMs, right? They're always poaching.
They are. That's the expensive lateral hiring game. ARWL mostly avoids it. Their secret sauce? 80% internal movements. They hire young, train them up their way, promote from within. It's cheaper, builds incredible loyalty, and ensures everyone follows the same discipline process. That's their real edge.
Okay, so fantastic business, great people strategy, sticky clients. Now let's clip back to those risks we parked earlier. The valuation.
Yeah, that's 70x PE, and the price to book is often over 30x.
What that means for you is the market has already priced in like perfect growth, maybe 20-25% growth continuing indefinitely. There's absolutely zero margin of safety baked in. If anything hiccups, the downside could be significant. Doesn't sound very lifetime holdish, does it?
Not at that price, no.
Yeah.
And then add in that SEBI regulatory risk we mentioned. Look, ARWL makes fantastic profits. Their net profit margin was 32% last year. A huge chunk of that comes from commissions paid by mutual funds to distributors like them.
32% net margin is massive for financial services.
It is. But that October 2025 SEBI paper talks directly about rationalizing those commissions, cutting them, basically. If that happens, it directly hits ARWL's main profit engine. It could permanently squeeze those high margins.
So the risk isn't just noise, it's a potential fundamental change to their profitability.
That's how the analysis frames it. It's why the management's own guidance of 20-25% profit growth starts to look, well, maybe a bit optimistic. When you factor in that potential regulatory drag, a more cautious forecast drops that growth rate down to maybe 12-15% per year for the next 5 years.
Okay, a 12-15% growth rate is still decent, but it's a very different story from 20-25%, especially when you're paying 70 times earnings for it.
Exactly. It completely changes the investment equation.
So wrapping this all up, where does this leave you if you're considering ARWL? The verdict from the sources seems pretty clear, doesn't it?
It does. Phenomenal business, world-class operation, great strategy, but not a suitable lifetime investment to start today. The price is just too high, and that regulatory uncertainty is too significant.
So the advice for someone with new capital is...
Wait. Wait for a much deeper price correction, something that gives you a margin of safety. Or wait until there's real clarity on what SEBI decides about those fees, whichever happens first.
Okay, wait for a better entry point or regulatory clarity. Makes sense. And here's a final thought for you to chew on. Even if you ignore the SEBI risk entirely, think about that 35% allocation to structured products.
Ah, yes, the market agnostic part of their returns.
Right. These things are complex. They're often unlisted, unrated, custom-made debt instruments, basically a kind of black box. So ask yourself, are you truly comfortable with a significant chunk of a supposed lifetime, maybe lower risk investment being tied up in something so opaque? Something to really think about.